Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Friday, September 23rd, 5:04 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with the Big Show, the Friday edition of the Revere Market Insight video, where we take a look back at this prior week, take a look ahead at what we need to know for next week, and not update but review the devastated 21/21 leaders list, as the market completely fell apart this week and leaders are nowhere to be found now. We just have to give the markets time to repair the technical damage and wait for the next crop of leaders to make themselves known. We've got a lot of dry powder available for when that happens, and we'll be compounding from a much higher capital base than if we would have ridden this correction the whole way down this year. So, state of the market, as I said, correction. Anybody following us has been aware of that. Anybody that follows the market has been aware of that. We're at maximum bearishness right here, meaning market leaders in a downtrend / neutral. They all came apart over the last 2 days. And the 5 major indexes are all below their short-term 21-day exponential moving average, below their medium-term 50-day moving average, and below the long-term 200-day moving average. There's a time to be in the market. There's a time to be out of the market. This is definitely the time to be out of the market. We might get some bounces over the next couple of days, but until we see signs of emerging leadership, we may need a catalyst of some improvement on the inflation numbers before that happens. But we're going to need definitely some improvement in the outlook, and the fear is high as far as investors are concerned. The recession seems to be priced in, looking at the yield curve, but the market will bottom while things still look bleak. We just have to be on alert for the signs that a bottom is being put in. So what happened today? Gap down, continued lower, and then finally bounced near the 2022 prior lows. GROTECTION, G6. This is our Growth 6 ETF proxy, down 2.83%. This thing has really had a bad week. S&P 500 gap down 1%, finished down 1.72%, was down almost 2.5%, almost 3% on the day, before rallying over the final hour as some people collected their profits on their shorts. S&P down 1.72%, Nasdaq 100 down 1.6, Dow down 1.6, mid caps down 2.3, Russell 2000 small caps down 2.5, global diversified 60/40 stock bond down 1.42. In-house, our flagship GROTECTION portfolio, our robo portfolio, all in cash, flat on the day. Some clients slightly different because they might have positions that recently transferred in that we're still assimilating, or they might have legacy positions that we have hedged. And also we have some mutual fund only clients that we take a little bit of a longer term on, that are mostly in cash, but not completely flat, but certainly a good day on the indexes to be out. We went to cash yesterday, stayed out of the carnage today, and we'll see what next week brings. So let me briefly explain our methods here at Revere, why we do what we do. I'm going to do that using a chart of the S&P 500. As I mentioned, 3 time frames and leadership is what we track. If we flash back to last year, October, November, the markets were trending higher above their short-term 21-day, medium-term 50-day, long-term 200-day moving averages. Everything's fine then. We're very involved in the market, probably 100% long, or to the extent that we're comfortable being long. And if the market things start to roll over, start to slow down, our stops will take us out of the market. When we consolidate, you never know how long you're going to go sideways. And here's a false breakout in late December, and then we started rolling over again. But then we started rolling over, and it turned from more than a consolidation into a downtrend as the slopes of the line started rolling over, and then we broke below the 200-day moving average. And this is when we really get maximally defensive, because the numbers tell us that the most severe corrections and bear markets occur once you get under the 200-day moving average. Usually you start between 10 to 12% above the 200-day, and then the rest of the damage beyond that is done below the 200-day. So once we break that, that's when we really get out of the way. You can see these dark shaded areas here. Those are the severe bear markets. On average, they drop. The S&P 500 drops 44.5%. You need 80% to get back to even. If you're approaching retirement, you can't afford a hit like that to your nest egg. That's why risk management and minimizing losses is job number one at Revere. When you minimize the drawdowns, the returns take care of themselves. We really started to roll over in April, completing the first leg down. Sorry, the second leg down. The first leg down completed here, beginning of March. Then we had a nice bounce, got back above the moving averages before the second leg down, which bottomed at 36.36. Then a nice rally up off the lows, but ran into the declining 200-day moving average. Big resistance area. We failed there, and we've been in the process of this third leg down ever since. And following these rules keeps us out of trouble, but even more so, it keeps us involved in the market when we need to be, because we've got various short-term indicators that get us back in once we get above certain moving averages, or when we bounce at support levels. So that's our system. You're interested in learning more about this, email me, don@revereasset.com, or phone 855-REAL-WEALTH. That's 855-732-5932. So there is a rundown of what's going on with the S&P 500. You can see here another gap down today. Really a rough week for the S&P, down 4.64%, but it did bounce very near the level of the June lows. We undercut on the Dow. This looks a little bit like this area here, or like this area here, so we may get a relief rally of a couple of days off of there. But right now, what we would be looking to do is to put shorts on bounces into the declining 8 or 21-day moving average, unless the market can get through there, start to pull back, hold, put in a bottom, and we see some of the stocks that had held up as leaders above the 21-day moving average start to put in the right sides of their bases and come up the right side, and then we'll have a crop of leaders that we can invest in, along with healthy action of the indexes. And that could lead to the next leg up. We'll be ready for it when it happens. Okay, so there's the S&P. Let's go to the Nasdaq 100. 269.28 was the low from mid-June. 272 the low today, so not quite an undercut, but we did bounce here. Again, rough day, or rough week for the Nasdaq 100. We did undercut, as I mentioned, on the Dow Jones Industrial Average here. In fact, it's the closing low also. This closing low back in June was 29,889. Today we closed at 29,592. So new closing lows on the year for the Dow Jones Industrial Average. Note that this is happening even though relative strength over the last 2 weeks has been picking up, which is typical. When you start to accelerate to the downside, it's usually the higher beta stocks that lead that move lower, and that's pretty much what we've seen. Mid caps didn't quite undercut. They bounced also near this 400 level. That's a pretty key support area. And small caps, IWM, didn't undercut as well. Low of 165 today as compared to 162.78 back in June. But the IJR, this is the S&P 600 small cap, did in fact undercut and bounce just like the rest of the indexes did. So little bit of a small cap divergence there between the S&P 600 and the Russell 2000. So what does it all mean? Let's go back to the S&P 500 and let's bring up the tail of the tape. So starting at the top, No change here. Same macro headwinds we've been facing, also technical headwinds with the way that the markets have been behaving. The stochastic indicators for the indexes in the G6 hooked down last week, and that indicated a failed rally off of the bottom, and we're very oversold now. That's one of the indicators that we'll be looking for should they turn back up and get above their oversold level. Put call spiked today, highest it's been in a while, 1.35%. VIX spiked also. It was made a high of 32.31, up over 15% at one point, closed at 29.92, certainly above that 26 maximum level that we keep an eye on, and it's above all the moving averages. So a breakdown of this back below 26, especially 24, and below the moving averages may involve a chance to have a playable rally where we could make a little bit of money on the upside until we ran into declining moving averages. We'll have to see how that unfolds next week. Fear and greed dropped into extreme fear range at a 24, still very clearly operating under this bear case, which was confirmed on 9/13 with the terrible CPI data. Powell spoke again today, reiterated the same stance that he did in the FOMC meeting on Wednesday, which was responsible for this latest leg down. Nasty reversal Wednesday, gap down Thursday, gap down Friday. I think we just ran out of sellers and decided to cover some longs at the end of the day. So we're down at 7 out of the last 9 days, very stretched to the downside. I mentioned AAI bears hit 61%, the fifth highest reading since 1987, but this is a secondary indicator. It's a very negative sentiment, and this is usually a contrarian indicator, but we got to see some more signs of bottoming before we can put any credence to it. Came in with a negative expectation after the 921 breakdown. The gap down confirmed that, and then we saw some panic selling intraday before we reversed off of the lows. We broke the S&P support level at 37.15, bottom of the range, now below 3700. That'd be the next support area on any bounce where we possibly could take a short also. Nasdaq 100 undercut but closed in this support range of 275 to 277. Gap down, I mentioned that. Here are the ranges on the day. Individual sectors, dollar up strong today. The dollar is really impacting this market overall as it just really continues to rock higher. Let's take a look at the UUP, second gap up in 3 days. Just no help whatsoever. Look at the relative strength on this. No help whatsoever to stocks, the strong dollar. Certainly something we need to see come off a little bit if we're going to have any sort of a relief rally. And then the only other sector that I could see was positive was home builders ITB, but that thing is in the toilet too, hasn't quite broken new lows, but certainly not something you'd be interested in investing in. 11 out of 11 sectors were down today. In particular, oil just got taken apart. XLE down 7%, OIH down 8.7%, XOP down 8%. Party over for the oils. Too much technical damage done now. XME also had a rough day, as well as gold and gold stocks. Gold just, you think it might be a safe haven to get into, but as long as the dollar's strong, gold making new yearly lows. Can't fight the strong dollar. Focus coming into today replaced the list of tickers with just a focus on maybe some opportune shorts on bounces into formerly broken support that now would turn into resistance. Portfolios in all cash as we went there yesterday morning after our last stops took us out of the market. Bottom line is that we bounced near the lows, but time's needed to heal the chart damage. So let's take a look at some support and resistance levels here. You can see today's close at 36.93. The next level down is 36.36 and 36.47, which were the lows of mid-June, and today's lows, which is where we bounced. I took out a few of these overhead resistance areas because we're just too far away from them now. So really what we're looking at now is for time. Market needs to put in some time to improve its overall look in the indexes and also the leading stocks. And let's get to those last 21 leading stocks. This is our 21-21 list from last week. We're going to sort it by how far prices are below the 21-day simple moving average. They don't use the exponential in this result set, but you're going to see, based on where we are, what happened to these stocks this week. And when we recorded the podcast this afternoon, every single one of them from last week had been taken out below the 21. So let's take a look here. Plug Power very clearly broke the 21 and the 50 and the 200. What we're looking for, this was the list of leading stocks as of 7 days ago. These were those that held up the best. So really what we're looking for is any that are maybe between the 21 and the, not maybe, but definitely between the 21 and the 50, because those will be holding up the best. There may be some bouncing at the 200-day moving average also. One of our tactics for getting back into the market is a list of the titans of America, so to speak, and very often if they can survive at the 200-day moving average, they'll come off of there, as value managers will look to pick up shares of those. There are value managers out there that think that this is the greatest thing that's ever happened, and they'll look for reasons to buy these based on fundamentals. That's not the way we play here. We look for strength in strong markets, but we do recognize what some other people in the industry are doing, and we'll take advantage of that if we can. But for now, Plug is broken down. AXSM, Axum Therapeutics, breaking the 21 and the 50, but hanging close to the 50. This was definitely strong since this phase 3 gap up a few weeks ago, but now it's given it all back. ENVX, one of our leaders, sitting right on the 50, so this is one that is holding up pretty well. Shockwave broke the 21 and the 50, definitely a leader, still holding the lows of this high volume gap up day on earnings, so some pretty good stuff there. Still keeping this around on the leaders list, but it has given it up for the time being. Ccj Uranium Stock broke the 21, broke the 50, bounced at the 200. This is an example of a stock where it's in a group that's in demand because of the renaissance of nuclear fuel coming back. They're one of the leaders in that group, but it may be a case where the 200-day moving average can put a bottom on in this stock. It's just we need a little bit more information for that to happen. ChargePoint, decent stock, broke all moving averages. Pinduoduo still above the 50-day moving average. ON Semi bounced above the 200-day moving average, again with the silicon carbide need for the EV sector. This is a stock that has the fundamentals in its favor, but we need price to be verified. We need the fundamentals to be verified by price, and with the market going down, everything got taken out this week. Livent LTHM bounced above the 50-day moving average. Again, lithium needed in EVs. All of the clean energy money in the Inflation Reduction Act that came out, billions of dollars going into clean energy, and this is one of the companies that's benefiting from that. So this holding up okay. Enphase Solar, another beneficiary of the Inflation Reduction Act, sitting on the 50-day moving average. Chipotle, we got stopped on this week, and it really came apart below the 21 to 50, but holding the 200-day. This is an example of one of those stocks that is a tighten off the 200. Big move up on its last earnings report. Chipotle seems to be handling this weakness in the economy just fine, and the supply chain. But as I said, all stocks, they come to get the leaders at the end of a rally when the market completely breaks down, and that's what happened this week. Chipotle still high on our list for maybe another one of those stocks that bounces at the 200-day moving average. Cheniere held the 50-day moving average below the 21. We also have been in depth here about the need for the LNG plays, but again, the market caught up to all these stocks yesterday and today. Tesla held out for a long time, but you can see very consistently these last 3 days in the market took the last set of leaders down. Albemarle bounced at the 50-day moving average. This is another one that has a great industry group story. Wolfspeed, again, a silicon carbide play. broke the 21, actually finished positive today, one of the few stocks, and it's above the 50-day moving average. This stays on our leaders list. BJ's between the 21 and the 50, still holding up very well since its stellar earnings report. Sarepta between the 21 and the 50, a lot of these holding up just fine on a relative basis. And if they can form flat bases or cup and handles, they could continue to be the leaders of the next leg up. This next leg up will come, absolutely it will, and we'll be compounding capital, being only down 7.8% on the year versus 22.5 that the S&P is down. So big gain, 1,473 basis point gain over the S&P at this point. We've got a lot of dry powder to put to work. WCN, Waste Connections, Pollution Control, had some money flow into it over the last couple of weeks, but gave it up. And when I say money flowing into it, what we're doing is using this relative strength line here to reinforce what's holding up the best. Northrop Grumman basically had a 2-day move off of Putin's saber rattling, closed on the 50-day moving average today, still showing relative strength. CEG Constellation Energy closed right below the 21, another clean energy play holding up really well. Look at the relative strength line on that. And finally, First Solar, one of the strongest stocks in the market, survived the 21 day. So we had one stock right on the 21 day. First Solar, you are the champion. And that is going to wrap it. As always, we'd love to hear from you. Email me, don@revereasset.com, phone 855-REAL-WEALTH. That is going to wrap it for the week ending. And what a week it was, the week ending September 23rd. Remember, it's not how much you make in the market, it's how much you keep. We've guided you very well this year. We guided you through the COVID sell-off, getting out of the way of that, getting in from a much higher capital base, and we're going to repeat that again when the market goes back into its next bullish phase, capitalizing from a much higher or compounding from a much higher capital base. So that's going to wrap up the week. Don Vandenbord with Just the Facts here, folks. Thanks for listening and have a great weekend.